Hello, hello. Make sure everything looks good.
Oh,
Hey, how are you?
good, good. How are you?
Good, good. All right, so who all we've got? I think some folks may not be joining because there is a Charles Schwab workshop happening
Yeah.
in Bay Area, and I know some of you guys are attending that one. I also wanted to attend, but I kind of I don't know whether I missed registration because I thought I registered it, but I could not find the link. But anyway, even if I had registered it, I wouldn't have been able to go because I've been pretty busy in a lot of other stuff. So glad to be here. Okay, Sam, what do you got for us? Okay, here's some. All right, so how's the markets been treating you? Anyone joining here for the first time? Any new joinees here?
Hey Vivek, this is Nandeep. First time here, and nice to see you on the camera.
Say, good to hear your voice, Ladeep. Probably joining the meeting the first time, but we have known each other for years now.
Yeah, yeah,
Exactly. So welcome to my new role. Uh, and I think probably like a few years ago when we were chatting, I told you that hey, I've been getting serious around investing, and I think 6 years ago I started this meetup because I just wanted to talk about investing. And so we meet every week. Good to see you here. Every Saturday, if I'm not traveling or if I'm not busy, we'll just show up here.
great. Thank you so much for inviting me and letting me know about this event. I look forward to being here and learning a lot from you and everyone else here.
Yep, cool. Yeah, I learn a lot from this community. So thanks for joining. Anyone else here joining for the first time?
Hey, Vivek. Yeah, my name's Nilishan. I'm joining for the first time as well.
So yeah, Nilushan, if you want to introduce ourselves, Nandeep, I'll get back to you. I forgot to get your introduction because I already know you for many years, but the rest
Yeah,
may not know you. So Nilushan, a quick intro on who you are, where are you joining from, and what kind of investor you are, and what you're looking to get out of next 2 3 hours.
Yeah, well, I'm joining from Vancouver. I'm new to retail investing and just trying to absorb as much information as I can from people like you.
Oh, welcome. For whatever reason, I have more Canadian friends joining. I know last week also someone new joining from Canada. So, but good to have you here. I saw one more hand was up. PK.
Yes, hi. My name's Preeti. I am joining from California. Um, I don't know anything about investing, so thought I would join. This is like my second meetup group, so yeah.
Cool. Good to have you here. Preeti, if you can ping me on, if you're completely new to investing, I think 2 years ago I did a series of sessions in terms of if you have never invested, what some of the basic steps to get in. And frankly, the first step is actually not investing. It's more important is to get your personal finance side of the house fixed before even you think about investing. So ping me on Meetup and I'll be able to share the link to the recording of those. I think those are somewhere on YouTube, but I can share the link in terms of which sessions are those. And that applies to anyone who wants to either review it or say, hey, I'm joining for the first time. Where do I even start? How do you even think about investing? So that's something I covered, I think, 2 years ago. It's a series of maybe 3 or 4 meetings. I just talked about very basics of investing. Okay. All right. Anyone else here for joining for the first time?
Yes. Hi, Vivek. My name's Kunal. I'm from San Jose, California as well. Um, Not so new to investing, but just want to grow the capital I can create with savings and other investment opportunities. So just here to learn what the trends are and risk assessment and so on, and knowing where my appetite is in all this.
Cool. Welcome, Kunal. Yeah, we have a lot of folks from Bay Area, I think, and there's one ask a lot of folks have asked me earlier. Maybe do an in-person. I'll probably think about doing an in-person, but till now I've been avoiding it because I didn't want to have anything else on my calendar. I just wanted to keep the time for my daughter who'll be entering college this year. So then I'll have a lot more time. I see one more hand up. Sai.
Hi, Vivek.
Yeah, Sai.
Yes, I'm Sai and I'm from Virginia. And
Mhm.
I have experience in finance. I was in part of research, but I have a little bit of experience in investing. And it's been a while that I have not invested in US markets. And now I want to know and then restart investing.
So you said you have a experience in research in finance. So what kind of experience are you
So
talking?
I played a major role with for New York Stock Exchange data part. So where I have done research on the fixed income instruments like bonds, debentures,
Okay. So mostly on the fixed income side.
fixed income side, yes.
Okay. Is it like analysis of the fixed instrument in terms of the risk and all that stuff?
No, mostly I was into collecting the data,
Oh, okay.
terms and conditions, TNCs.
Got it. Got it. Okay. Thank you, Sai. Nandi, before I forget.
Oh, hi. Yeah, Vivek. No, it was not a problem. Actually, I forgot to introduce myself. I am new to. I don't want to say I'm new to investment. I'm new to options, and I do manage a portfolio, and I have been in the healthcare sector for quite a few years, and so I understand that space very well. So I thought, when I spoke to you, I found it very interesting about the concept of options, and I felt there's more to benefit, as you said, from the community, and so I'm here.
Cool. Yeah. I think on a daily basis, I don't have I don't bring a lot of option discussions unless someone has a question, because a lot of folks out here don't trade options. I don't know why. I think everyone should get involved. It's a great tool to manage your risk. That has helped me to manage my portfolio and reduce the risk. But I mean, it's everybody's their own preference. But if you have questions, etc., feel free to ask, jump in, put it in the chat, and I'll address that as we go along.
Oh, sure. I mean, I didn't like I said options, but I came here to be a part of the whole community.
Yeah.
There's
I
a lot of
understand.
other things to talk about,
Yeah.
other topics I'm sure you will have. So I'm
So
open for that.
so the reason I moved from just talking options to overall investing was I saw a lot of new, investors, I would say new to investing, people got burned because options is one tool in your overall portfolio management. It has to be always in the context of what you have, and then apply options as an icing on a cake. So what I saw in 2022, you got a great icing, but it's sitting on top of turd, right? So really didn't help. So I was like, okay, I need to now talk more about first the basics on how to find great businesses. Options is just an overlay. All right, anyone else for here for the first time and haven't introduced? Otherwise, we'll get going. Okay, looks like we got uh yeah, all of the names seems to be familiar ones. Okay, and some of the folks are in Schwab. Maybe next week they can tell us what interesting things that they found from Schwab workshop that's happening in Bay Area right now. All right, so let's get started. I will share my document as always. Okay, please confirm what are you seeing on the screen so I know I'm sharing the right stuff. Where did the chat window disappear? Samir said, glad you chose to be here. I mean, I love doing this shit every week. This is fun for me. Ilushan, Ravi. Okay. All right. Are you guys are seeing the document? Yay, nay? I do not end up in a situation which has happened once, a few times earlier.
Yep. See it.
Okay. That I spoke for 10 minutes and someone pinged me, are you sharing anything? I'm like, what? So Ramesh says, no, maybe it's on a different screen. Homepage. Which homepage? Which screen am I sharing? Are you seeing that like weekly meetup discussion 324?
You're sharing the right
Right
screen.
screen. Okay. Cool. All right. Good morning, good afternoon, everyone, depending on which time you're joining from. Welcome to our weekly discussions around everything around investing for as a DIY investor. How to stay active, how to stay invested. And thank you for joining in. This is our discussion number 324. And today I actually wanted to cover a big topic around funds, right? I'm seeing a lot of new issue, coming in the market, and just by name, mutual funds, the ETFs are have a lower risk, but I think there is a lot more to just the name. So I wanted to cover in terms of when you're looking at a fund, how to analyze the fund. I mean, we have done the in-depth analysis on individual stocks, right? Businesses, what parameters to look at, but we have not. I don't think I ever covered in terms of as a detail in terms of how to analyze funds, right? What parameters goes in when you're looking to pick a fund, right? So this is going to be a different discussion. I'm not going to talk about gross margins or free cash flow conversion and all that stuff, but I'm going to talk about the mutual funds, and then also we'll spend some time on the craziness that I'm seeing in the market in a lot of ETFs, right? So that's one topic, and of course we'll talk about the macro stuff, the key macro news from this week. This is the first meeting after the end of a month, because end of a trading month, I would say. We still have one more day to go in May, but markets are closed tomorrow. So at end of trading month, I always share in terms of my top 15 holdings in my portfolio. So you'll get a peek on my portfolio pizza, and a quick update, on the 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 tool that I've been working on for quite a few months, something that I've been using it for years, but I know there was a ask from this community on how can you guys get access to it. So okay, then I had to build something. So that a little bit about that one. Anything else you want to add for discussion? I think probably we are here. We got what, 1 hour 45 minutes, right? And I don't think we'll be able to cover it all, but let's see how much we can go through. I always want to have more content than the time. We should not run out of content, right? That'll be bad. So let's get started. Before that, any questions? Anything else that you may have in your mind? And
Yeah,
say,
Vivek,
like,
the tool, you said you're going to do some sort of training or something on it, or you're going to have another session, or is this a session for that?
No, so from a 12 to 1, we'll split, and I have a breakout room wherein those who have been part of the first batch. Okay, so let's talk about that. Okay, so first thing I want to start around with the Optalyzer, the tool that we're building about, and I know a lot of you people have got onto the wait list, and so I want to start small. I sent out invites to 10 people, and your access have been, if you are one of those who have received invite to try it out. Your access has been enabled as of today morning. And I'll walk you through from 12 to 1. We'll get into the breakout room, and I can walk you through if you're having any issues in terms of using it. Should be pretty simple and easy to use, but yeah, I'll be there to answer questions. I have some demo accounts I can show that, and that's a pre-filled data, and then I can also upload the data and show you. So that will be from 12 to 1, right? Yeah. And those who have signed up but haven't received the invite yet, first thing, I sent an invite to those who are using Schwab, Fidelity, and Tasty Trade. If you have account in these three brokers, probably you're higher on the list of accessing the tool. You'll be the first one because I have these three accounts. So I have a real world data and in order to build this and test it out. If you have other accounts with other brokerage firms like E-Trade, Robinhood, maybe ping me, and I will need your help in terms to get some real data, to test it with some real data before I release it. Okay, those brokerage firms will take some time to build because I don't have account with those, and I don't want to release it something which is haven't been well tested, etc. Cool. All right. So first timer. So what is this Optalyzer about? This is that as a retail investor, when I got into options, like trying to do it seriously, I realized that none of the brokerage firms actually provides me the information that I need to manage my trades, right? If you really want to manage it like a real business, right? So which is what, in my case, that's what it is. That's what pays the bill. So I built my own tool, which will give me deeper insight into how my positions are doing, what's coming up for expiration, where I have a risk, which strategy work and which one not, and all that stuff. I just shared the link if you want to get on the wait list. This is the link, and yeah, that's what it. And then I started adding a lot more stuff, so like the stock financial analysis, the framework that I run through, 13F-Analyzer, in which I look at 100 funds and across the holdings across various quarters, how the money is moved from one place to another, so on and so forth. So we'll be rolling out all that information in the same tool. It started just from an options, but I have all these things which are scattered around different on my machines on a different tools. I just want to consolidate for my own mental, I would say, a piece, and for own ease, everything gets one place. It'll become much easier for me to manage it. Vince says IB Care is great broker for options and future. I know I don't have account with IB Care, so Vince, if you ping me, you can help me in terms of downloading some data, CSV, then you can anonymize, or and this goes to everyone else. You can share me some your anonymized data, etc. I can at least make sure that, and then I can work with you to enable that in the tool. Okay. So don't spend more time on this one. From 12 to 1, we'll be in a breakout room to help those who are in the been invited in private beta, or for anyone else who want to know about the tool. So I'll spend time more on that one, right? And I think over this week and for next few weeks, I have scheduled couple of slots. One during the market when the market is open, one when the market is closed. I'll be available to answer any questions on how do I use this, where can I see my net cost basis. I've collected premium over last 5 years. So what's my net cost basis? How do I see what's the impact of the ETF that I hold in my portfolio? How does it impact my overall position sizing? So all that is covered in the tool. Cool. All right, so let's start going with the overall, the macro level. So what did I see at the macro side? Hey, we have a new highs. And this market is, sometimes you feel, what's going to stop this market? Looks like nothing. And it's been climbing every wall of worry, despite all the tensions that we are seeing. And if you really look at it, we have a after COVID, we have had so many shocks, geopolitical shocks, macroeconomic shocks, wars, and everything, and still the market is up, is at a new all-time high. Right? That's amazing. And of course, there are also concerns. Are we looking at dot-com kind of a environment? Yeah, so we'll talk about it. But again, this week, markets are at new all-time high because there was once again, maybe 50th time, there is a hope that US and Iran will have a peace agreement. Last time I checked, I don't think the president has agreed to the agreement yet, but there has been some negotiation going on to extend this truce, the ceasefire, for another 60 days, I guess. Someone can correct me. I haven't been too close to the news. Watching political news is not my favorite pastime, so I could be wrong on this one, but that's my understanding. And I don't know, it's like a 50th time administration is saying, hey, we are very close to peace deal, and market just continues to go higher another 50th time. It is what it is. I love it. I'll take it any time of the day. But again, the optimism, there is one big thing which is driving all the optimism in the market, which is AI. So starting with the AI chips, starting with the infrastructure, and now we're looking at, James says, right, Dell to the moon. Absolutely. Like, and because of a lot of demand for Dell servers, because of the inference workloads that a lot of these hyperscalers are seeing, right? So we also saw another one. I don't think I have the earnings report covered today, but Snowflake. Anyone works here in Snowflake? Congratulations. Like stock was up like 36 or 33%, right? And this is sometimes is a little scary for me, is the magnitude of the movements that now we are seeing in stocks is like too much, right? If you do not meet the estimate, your stock is down 30%, and is sometimes if you meet or exceed your estimate, stock is up 30%, right? We never seen these big kind of a moves on such a big companies. Yeah, they start to behave like a meme stocks, right? Snowflake, like meme stock. On the other hand, we saw Zscaler, which came up with lower than the market expectations guidance, and the stock was down like 30%. Right? There is no middle ground. But it was fascinating to see in terms of Snowflake going up, and on the same account, Salesforce going low. Right? Anyway, getting back to the macro side, we had GDP numbers came out. Sorry, not the forecast. So it was revised lower to 1.6%. So might think, oh, come on, are we slowing down? Not really. There were a couple of factors that contributed to slow, revise the revision lower. One was like inventory and the trade, but the core measures, and which is where most of the US economy is dependent on, is a domestic demand. And that is still continue to look well, both from a consumer side as well as from business side. So consumers continue to spend, and also the business are continue to stay in the investment cycle. So from that perspective, the headline number of, hey, GDP growth is revised lower to 1.6% doesn't matter much. US manufacturing PMI, it rose up to 55.3. Chicago PMI, 4-year high of 62.7. So from that perspective, things look good from an economic perspective. This chart shows us in terms of headline GDP growth, which is the dotted line, and the dashed line, and the the things that actually matter, right? Sales to domestic purchases, business investment, household consumption, etc. So if you really look at it, I think we are still in a good shape. And that's why even if the markets are so high, it is difficult to be bearish at this time. Me for personally, right? Even though I've been trying to hedge my portfolio, but I continue to now roll up my hedges because hey, the economic it continues to grind higher. Are there some companies on the stocks that have gone way above their skis? Of course, right? But overall, I don't think we are at a stage here where I can ring a bell and say, guys, get out of the market, and because it's gonna be bubble and it's gonna prick tomorrow, right? So I will never be able to do it. I have no idea what market's gonna do in next 2 months, 6 months, or a year. That's not how we should invest. We should be able to stay in every type of a market situation. So, but economy is chugging along, right? Uh, a significant and growing driver is a boom in AI related investment, right? And we're also seeing a lot of spending on data processing, information processing, hardware, software, and R&D. Someone talked about Dell. That's what Dell went to the moon. Look at the Intel, what happened to Intel over the last few months, right? The demand for the CPU stock was like $17. When did we talk about Intel? Was it last year or was it 2024? Where it was trading at 0.7 price to book value, and I'm like, I think we should build some position. But then beyond 80, I'm like, I don't know what to do with this Intel. But yeah, there is so much of a demand that the investors have become very optimistic. So at some point of time, some of these areas I do get a little concerned, but I think overall, I'm still okay with how the market has been performing. I personally don't think that we can call it as a bubble just yet. Right? AI investment is providing a boost to aggregate US growth. And now this is the latest surge that we are seeing in AI investment, and the surge resembles the whatever we saw during the dot-com, right? We are now getting pretty close to AI investment as a percentage of US GDP, getting pretty close to the same investment in 2000. Right? So yeah, Sam says in 2025 and 2024 we talked about it. Yeah, it was because it was cheap at that point of a time, and my only thesis on investing in Intel was it is strategically important for US because in absence of Intel, we will be 100% dependent on TSMC, which is based out of Taiwan, and the huge risk of China will be looming on it, right? So that was my core investment thesis on Intel, and of course it was trading way cheap. But my core investment thesis is still the same. I can't say that thing about that it's still trading cheaper. A lot of future growth in the business is already been priced in the current price of Intel's. So if you want to buy Intel, be very, very cautious. Anyway, so this is one parallel which a lot of market commentators would draw is, are we looking at the similar euphoria of 2000s in terms of investment, and without saying it, what they also mean is we're going to get the similar crash. No one knows when if it is a bubble or not. We will only get to know in hindsight that it is a bubble. But remember, the companies in 2000 that were being valued and the companies in currently majority of the companies are very different companies, right? At some company level, I do feel that we are getting into bubblicious territory, right? But the damn thing continue to go higher. Who cares, right? But I think overall, at a market level, I don't think we are at that stage, right? And this is why corporate profits were up 12% over the past year. And what has S&P done? Probably close to similar, right? So this is very unlike in 2000, and I think I was reading about some stat, over the last 5 years or 4 years, whatever, or maybe 3 years of this AI boom, market is up 80%, right? And 80%, 60%, whatever, right? And the earnings are also up similar, 60%. So while we think that, oh my gosh, in the last 3 years, the markets have gone up too much too soon, but it is because the earnings have also gone up. And look at it, this quarter, the earnings growth is like 12% from previous year. So hell yeah, why would S&P 500 not be up 12 to 15%? Even though, it is being driven by earnings. This is very unlike during 2000, wherein the earnings were up over that similar period of time. Earnings were up 80%, but the stock market was up 200%. At an aggregate market level, we haven't reached that stage yet. I will be concerned if at an aggregate market level we are start to see that the market is a run up, like has become 3x in 2 years, whereas the overall S&P 500 earnings are up only 50% or 60%. That may be a cause for concern. And if you are holding individual stocks, you should also look into those and say how much have they run up, what's the corresponding growth in earnings either already happened, or I would say focus on projected earnings. What's the corresponding growth in projected in earnings that the analysts are projecting? Is it possible that we have already pushed up the stock price is so higher that the growth till 2030 is already being captured? Maybe in some cases, yeah, for sure. Those are the areas which I think we need to watch out for. But if you're investing in, and if you're not following individual companies, there is no business of you to invest in individual companies, right? If you're not interested in reading their earnings report, if you're not interested in listening under the earnings call or going through their slide deck or following the CEO, not stalking, but let's say on a social media and say what they have to say. Yeah, don't invest in individual companies, right? Just pick ETFs, and have the ETFs that done great. But the earnings is also growing up, and that's why if market is up 10-12% for this year, I think I have the number. It is because the earnings do support them, right? Strong and stable profit margins are underpinning these earnings power, and which is like have a constructive outlook for equities, right? Now, some of you may come back and say, hey, Vivek, right now, this whole earnings power of or earnings growth of 12% is only because of the fewer companies, right? You can maybe pick up top 20, 30 companies, and that's what driving the whole index up. Who cares? This is how the index composition is, which is market cap weighted. And some of those market cap weighted companies are also the bigger companies and are also the better businesses. And if you don't like that market cap weighted index, maybe go and invest in other index. But rather than me trying to somehow prove a point on, oh no, this is concentrated, this is not good. I'm just looking at what the data is telling me. If I'm invested in S&P 500, S&P 500 earnings is up 12%, and S&P is up 12%, then I don't think that it's in a bubble territory yet. The problem that we need to watch out for, and this has nothing to do with, let's say, individual companies, but at a macro level, is inflation. Many markets have been inflation in the past has been a reason why many markets have crashed, because inflation stays persistently high, which will then impact the earnings power and also impact the liquidity in the markets. So we had some PCE inflation that came out. We are looking at PCE increase to 3.8% year over year in April, right? Which is basically 12-month annualized. You're looking at 3.8% growth, which is hot. Fed target is what, 2%? It's a different thing that we haven't been able to meet that target for like last 5 years. So maybe we should revise the target. I don't know, but I don't control that. So there's no point in us debating it, but it is what it is. Fed target is 2%, but we are now sitting at 3.8%. I think the more important thing is because the inflation is still higher, a lot of Fed governors, they are talking about maybe raise the rates if necessary to cool down the economy. The people that get impacted by the inflation are the ones who are already in a difficult financial situation, right? Those who are well off, those who have financial assets, they do well, right? But those who don't own financial assets are living hand to mouth existence, paycheck to paycheck, hardly have any savings, or sorry, hardly have any investments. Those are the ones who get most impacted by inflation, right? It erodes your earning power. So with the fact that now we're going to have midterm elections, right? I don't know. I know our president want Kevin Walsh to cut interest rates, even though he said during the swearing ceremony, go do your work, go do your stuff. We all know how that goes, right? So, but given that the inflation is still 3.8%, I think Kevin Walsh's job is becoming more and more difficult. Again, he's not the one who will all the it's generally a consensus decision with the Fed. Whatever viewpoint he has in terms of whether they want to cut the interest rate or reduce the interest rate, he has to rally his team members to support him. And now we are seeing more Fed officials actually talking about increasing the interest rates. That could also, throw a little wrench in the markets. Markets don't like higher interest rates. So that's at a macro level. I think. Hold on, let me just go back to. I had a chart for Fed probabilities. Let me go through where that is. Okay, maybe we'll go through it, then we'll come back to ETFs. So always want to look at what the market sentiment is telling me. And like market, this is a CNN fear and greed index. It is driven based on the 7 parameters. We talked about that in many meetings. You can go and look at it, which basically tell us how the participants are feeling about the market. And for me, this is actually a contrarian indicator. If the market is on a greed, I want to sit back, enjoy, and not get into FOMO. This is a time when we have to avoid FOMO, because now you're seeing everyone is making money. Everyone is like trying to get in the market. That's the time when I want to sit back. I want to deploy the capital when the dial goes towards the red, right? When the fear and greed index is sitting at 10, or I'll love it if it's sitting at single digits, right? I think it was only last year during the Liberation Week, I saw it in a single digit. But yeah, so that's how I read it. Like Warren Buffett says, right? Be fearful when others are greedy, and be greedy when others are fearful. So I take it as a contrarian indicator. If you're a momentum investor, don't follow me. Then you would rather go with what the fear and greed index is telling you, like Stanley Druckenmiller has said, right? When I see a bubble forming, I run towards it, right? Not me, but Stan can do it. I don't think I can. So it depends on what kind of investor you are and how you want to make use of this information. And that is why I just cannot tell anyone in terms of, hey, this is good to invest in. I can talk about the company business. Now, whether that is a good stock for you or not, you have to decide. Right? A great stock for me could become pathetic for you. Similarly, 60 could be a great number on fear and greed index for some, and it could be a bad number for some. But this is the number I want to share. For me, over the years, Me taking a contrarian approach has worked well with me as an investor, helping me to sleep well. So I do want to keep track of it. Sector wise, this week, tech is leading the overall gains in the market. And of course, energy prices came down because WTI crude prices came down because hopefully we will get peace and the tankers will start to travel through Strait of Hormuz again. I believe that we are getting closer to peace, or I'll believe that the war is over once I see the traffic flowing through Strait of Hormuz. Other than that, in absence of that, it's all talks, right? It's all no walk the talk yet. So I will still be skeptical and and be a little careful until I see the gas tankers move from the Strait of Hormuz. Anyone knows what happens? Is the traffic flowing? Again, I've not been watching news. This week was like neck deep, heads down onto doing finishing touches on Optalyzer. So I don't know what happened. Overall, for this year, tech sector as a sector level is up 21%. Energy is up 27%, 25%, even though like this week energy went down 7%. Still, this has been the best performing sector so far for this year. Right? And the financials and the healthcare continue to rot. I don't think any week I've seen financials and the healthcare green. Maybe wrong, but I think at an overall level that theme is that every other sectors have worked except the financials and healthcare. Right? As a retail investor, if you're not looking at don't have any expertise in individual sectors, if you just got S&P 500, still done good. We're ending 5 months and we are up close to 10%. What else? What more do we want? Over the last 1 year, we are up like 27%. But that's I think it is because we are comparing with the Liberation Week. The drawdown after Liberation Week. So probably that is a little more, I would say, skewed. But last 5 years, we are up 80% on S&P 500. And if you look at last 5-year earnings growth, you will find it probably close to 80%. So we've still done pretty good. I don't know what's going to happen this year. This May was not the May to follow sell in May and go away, right? That's a term you'll see financial media talking about, sell in May and go away. No, not this May. This May, if you had sold at the end of April and gone away, that was not a good move. This May has been great. All like YTD gains, half of the YTD gains have come in last in May. Market is up like 5.5%. So don't sell and go away. Right? Okay, let's talk about the ETFs. Before that, any other questions, etc.? I see shadow QE Fed money injection is the reason. I'm not seeing Fed money injection. Where are you seeing those numbers, James? I think I do have some charts around Fed balance sheet. We are actually going down. And since we talked about it, maybe we just look at it quickly. There are some Fed chart that I do have. Where is that? There we go. I'll skip that. Yeah, so this is the money market fund assets. We still have $7.7 trillion sitting in the money market fund, right? I don't know what are they waiting for. Maybe that money is never going to come out of the money market fund because we've been watching it since it was 4 trillion and 5 trillion, I think a couple of years ago. And every time that, hey, there's a lot of money sitting on the sidelines and that bode well will bode well for the stock market if those who are sitting on the sideline start to invest, right? But the pile on the sideline continues to grow up. So sometimes I feel that these are the people or the savers or the investor who just don't want to have anything to do with the stock market. Nothing wrong in that. It's their makeup. I know a few people who have been sitting and saying, "Cause I just don't want any volatility. I want uh, guaranteed returns. Right? Guaranteed returns. If it is 4%, I'm okay with it." Right? So for those investors, if the money market is giving you 4%, they're just not moving in the stock market. I don't know. But there are people who will not invest in the market, come what may. And this now we have 3 trillion from retail investor, 4.5 trillion from institution. We should see how the numbers look like once the Fed start to decrease the interest rate. And now if you cannot get 4%, I think 30-year bond touched 5%. But if we can no longer get 4%, maybe then some of that money might move to the market in search of higher yields. But right now 7 trillion is still sitting. 30-year mortgage is been continuing to inch up. This is the Fed balance sheet, right? So I don't see in terms of where the money injection has happened. It's actually going down. Fed has been reducing its a balance sheet. It's not selling, but it's not renewing the asset that it used to hold, right? So they have been trying to reduce the balance sheet. I know Kevin Walsh is one Fed governor. I think was in 2000 or 2000, maybe 2008. He wrote an article around, basically promulgating the fact that Fed should have a lighter balance sheet. So I would be surprised to see Kevin Walsh actually supporting a heavier balance sheet on the Fed side. Too much sloshing around. Oh, okay, we just talked about it. I mean, there's too much money on the sideline also. IGV software is waking up. Sure, we given up these things for dead, and now those investments in IGV is now doing good for my portfolio. Buying them when they were like 80 and 75 had a lower risk. I still hold them, will continue to hold it. Samsung to 2025 and 24. Oh, that's maybe I think I asked a question. When did I talk about Intel? When it was at much cheaper. Yeah, probably 2025, 24. All right, so let's talk about ETFs. Anything else at a macro level? Any other questions? What else did you see in the market? Again, I've not been the one who watches the screen, just stares at the screen. I hardly, my trading time is hardly maybe 1 to 2 hours. Most of my time goes in either studying or over the last few months is all going into trying to build new functionalities. So you probably might know more about, hey, these are the other stuff that's happening in the market. Oil stocks. The fact that, again, I don't have much insight into oil as an industry. I do not know what drives, what are the factors that differentiate one business or one company from another. There are multiple categories on the oil side: upstream, midstream, downstream, etc. So for me, trying to understand the oil as a sector, crude oil as a sector, is too much of work. So I stay with an ETF. Now, the question around the oil stocks, again, I don't know about the individual company stocks because I don't follow them. The fact that these stocks, a lot of these energy stocks have run up because of the Iran war. Now, if you're looking at a crude price cooling down, that will hurt or impact the margins of these companies, right? You can no longer charge $6 for filling a gas in California, then you can no longer enjoy that heavy profit, the hefty profit margins. So I would be cautious in getting into these oil companies at this point of a time. I know there are some other who are much better in commodity investor. Anyone else want to pitch in? Any other commodity investors? I'm not a big one, but looking at what the energy stocks and some of these oil stocks have already done, I don't think these are available at a cheaper price. Having said that, should you have an energy exposure? Yeah, sure. I own XLE, and I think I had a covered call, got called at 55, and then I've been trying to sell a put at 55, trying to just get back the share that got called away, right? So in that last 3-4 months, collected some $3-4 already in a premium. Right? But this is what I told. We're looking at ExxonMobil, Chevron, ConocoPhillips. Again, I don't know the what the business mode that one company has over another. That's why I just buy this ETF. Right? Many of these companies went high because of, hey, the war means the disruption in the supply chain means you can charge higher prices. So, which maybe if you can look at the oil crude futures, those who trade futures probably could see that the market is expecting futures to basically price lower. All right. There's some other comments. Ravindra, is SAS back? When did SAS go away? I mean, the market gets crazy sometimes. Right? It's not first time we have seen it. In the market, pendulum always swings too hard on either side. We'll get a euphoric on one side, and then we'll get despondent on other side. Right? And that's what on SAS, it was SASocalypse. Every stock got punished, and now we are seeing those stocks coming back. Like Snowflake came back, right? Like up 36%. And then we saw Microsoft also going back up. And yeah, at the end of the day, I don't think you would be able to replace some of the softwares like CrowdStrike by building a homegrown cybersecurity solution using Mythos or Claude or whatever, right? Pick your code LLM. Would I be okay to build maybe a time tracking software for my employees? Sure. If that software has a bug, what can go wrong? Maybe, some employees' hours got nixed. My the cost of mistake is lower, but I can't take that risk with some of the companies like cybersecurity companies, right? I'll get hacked. So I think but when the market swings too high, they'll also throw baby with the bathwater. We have seen that in 2022, when a lot of companies with the great cash flows, even if they don't grow, still would assume that there's no future growth, and still the market was, you're pricing it at like Facebook was one. Even if you think the advertising would have stayed where it was still much cheaper at $95. But market does that. Now, important thing is you need to figure out which companies will have a staying power, which companies will not. If you are a little system of record, if you are a company which software is critical in terms of either it's the regulatory stuff, means in which the mistakes are very costly, right? 99% is not good enough. In those areas, I don't think we are at a stage wherein an AI engineer, I don't think there's something called as a prompt engineer can actually build a software and I'm gonna deploy it in my production environment. So
Hey Vivek, this is Satish here. I just wanted to add few things about cybersecurity and especially we were discussing about mythos, right?
yeah.
Recently, I conducted a panel discussion with some of the CISOs in Bay Area.
Mm-hmm.
What interesting thing came out was actually we had a issue, especially cybersecurity industry, right? We come up with lot of findings about thousands of findings, and then most of the companies they won't fix all of them
Yeah,
because
CV list is too long.
yeah, they won't fix because it's expense. So what they do is they just uh, take only few important things they fix, but rest everything are accepted risk,
Yeah.
and then we just move on. That is what was happening until now. But because of this mythos and recent changes in AI, leadership is more serious about fixing them. So it's a, I mean, it's a paradigm shift now.
Yeah. And
In fact, yeah,
And I think there are more tools available and maybe easier to fix now. So earlier, if you have
correct.
to deploy, if you have to, carve out your engineering bandwidth to
Yes.
fix the issues that we thought we could live with, and then, yeah, I want to build new features. I want to build, which will bring in more business to me than spending the same engineering build, the bandwidth on something which, yeah, I think I can live with the risk. I mean, we have done during my corporate life, I've done the same decisions, right? Hey,
So
look at
bottom
the
line is,
severity.
what I'm trying to say is there is more opportunities now, especially shift left. It is called like threat modeling or static code analysis.
Yeah.
So there is more opportunities now. I mean, people. In fact, during the panel discussion, each of the CISOs they said they need people for to do those things.
Yeah. I thought I read somewhere, or maybe I heard somewhere in some podcast, the jobs for in the software industry started to pick back up.
Correct. Yeah.
It is because of these AI tools, people are creating so much of a software that we also need to maintain them. So again, I think it's too early to say how this will things will pan out, but I'm pretty excited about all these the new tools. Anyway, so thank you for sharing your inputs. Yeah, so these companies are not gonna go, not gonna disappear, but I guess a lot of these companies are using the same tools to do more and more. And now we can fix a lot of the vulnerabilities that we had, pushed lower in the order of priority because we could never find time and the bandwidth to fix it. Now you can have your whatever Claude agent or Codex go and start, work it 24 by 7 without, you know, you trying to do everything and then give you a report. You can monitor it before you commit and push it to production. Isn't that amazing thing to do? That's what keep me excited about all the stuff in AI is you have a worker who is a PhD level ready to work for you 24 by 7. Just, never had that before. It's similar like internet gave us the power that if there is an information available in the world, you can just get it. Compare that with the days, and maybe now I'm probably talking my age, when you have to go to library, find a book, and that was my sphere of the information gathering was the books that are available in the library. Once internet came in, it was like wow, right? Now these AI tools are doing similar stuff for the things that you can build. It's all limited by your imagination. According to Anthropic mythos, is designed to find, yeah, zero-day vulnerability, and I think they also have found a few. Right, that's why they released it only to some of the tech companies that didn't release it out to public. Anyway, let's continue and talk about ETF. Maybe let's look at a pizza because that'll be quick, and then we can look at an ETFs, and then come back to some more interesting charts for the day. So at the end of May, this is how my pizza looks like. So SPY continue to be the top holding in my portfolio, close to 16%, and I will like it to be that way. I want to have more and more ETFs and fewer individual stocks. So I become very, very selective in adding a new position. The business has to be really, really super exciting for me to add that individual stock in my portfolio. Have there been some stock that I've owned for, in the past and still sitting around in my portfolio gathering dust? Sure. But those are like really a dust a size portion in my portfolio. Anything new? Now the bar and has been higher, the gate has been raised. I really have to, see why should I not buy one of the existing ones, great businesses versus a new one. So Google is the number 2 because Google stock has been performing well. ACHD is number 3, and now you can go through some of the, you can go through the list on your own. If you have any questions, ask me. This does not include the cash unless it is in the money market fund, which is in the brokerage account. This only includes the long holdings. So no
And
options.
Vivek, from your total portfolio, how much percentage cash do you typically have?
Right now, it would be maybe around 4% because I've started keeping low cash because I don't have a W2 income, right? So I need to keep
4%
portfolio
makes
working
sense.
for me. Yeah.
Yeah.
Earlier, I think I used to have maybe around 5 to 10%, but over the last couple of years, I've reduced my cash. I've been very prudent in terms of putting money to work.
Yeah, it makes sense. And then what do you think of Apple at this? It's gone up quite a bit, right? So even I've got
Yeah.
Apple. I'm just wondering what to do about it because it's gone up quite a bit.
I believe Apple might turn out to be a silent beneficiary. We don't know about the future, but it's difficult for me to ding on a company that is a good cash flow generator, right? And they will be able to deploy the cash they however fit that they want to.
Being that there's a CEO change also coming, right?
Yeah. See, I mean, he's already changed, right? So the new guy, by the way, I was talking to one of my friends. He says he doesn't like the new CEO. Maybe he's asking them to work a lot more. I don't know what the reason is. I didn't ask them, but he's a product guy, comes from the product background. I love Tim Cook. But the only thing is, in under the ages of Tim Cook, we didn't see Apple bringing any great products. Sure, we got a watch, right? But there were many things that they tried, burned, and failed on. Apple Car tried, didn't work. Apple TV, not much successful. Then the latest one was their Vision Pro, like $3,500, didn't work out. So somehow the market was like, Tim Cook can run a business smoothly once the product, etc. Like the Steve Jobs and the Tim Cook was a perfect team. Right? Steve Jobs can think about these great products that consumers would want it, and then Tim Cook can work through the supply chain and the organization to make that happen. So Tim Cook, I would say, is a very efficient in doing what he does, but what he does is that really effective in the long term. I think the market is starting to question that. We haven't seen anything on an AI, right? In hindsight, it may turn out to be a good thing because they
Yeah, I
haven't
think
spent.
AI seems deliberate, right? They said they want to use any model and not invest in the model.
Exactly. So in hindsight, that probably is a better decision, and I appreciate that, the fact that they have not spending money like drunken sailors. And it is not easy to sit on $100 billion, whatever the amount of a cash that Apple has on their balance sheet. How much cash? They're looking at $60 billion, $70 billion of a cash, right? Many CEOs will be like itching to spend that money and to expand their empire. Tim Cook has been very deliberate in terms of where they spend money. And Apple in the history has been very deliberate in spending money. So, and I like that. That's why I can't get bearish on Apple right now. Because it could become a distribution platform for the other people to use AI.
Right.
Safari wasn't the most used browser, but Apple still made $20 billion from Google. They become a distribution platform for Chrome, right? So unless we start to see that the iPhone story is start to see some cracks in that, and I know that we've been like dragging as an investor, we've been pinning too much hope on one product, which is iPhone, but so far it's been working out. Of course, we had a couple of years where we saw some cracks in that, but recent like sales in China last quarter was such a great one.
Right.
So, and let me see, revenue is not growing. I'm sure shouldn't say not growing, but revenue growth is slow, 4%, like single digit, but the amount of a cash flow that it still generates is amazing. So I don't want to sell my position in Apple. Having said that, will selling a covered call be okay, or a call spread be okay? Sure, and I do that every time. Right now I have a covered call which is challenged. I think I sold it at 300. Now it is 312. Now I'm trying to do a defensive move. I sold a put against it. Probably I've collected $5-6 of a premium. Maybe I'll roll it. But I don't think I'm gonna outrightly say, okay, I need to lighten up on my holdings of Apple unless there is a need to generate cash. I have some other stocks which are not that high quality as a business. I would rather have them be called away than my Apple stock. That's my thought.
Thanks.
Cool. All right, I see some hands up. Sam.
Vivek, don't you think largely the U.S. stock markets are really overvalued? Now, for the last 2 months, though, the prices have gone down, and like one of our friends says, you can never buy something of quality at a discount. But obviously, I have in the past 2 months. And what do you think of Salesforce?
Salesforce, I've never owned Salesforce, so I don't know about the business. But Salesforce, I think the concerns are we want to see how much of their AI revenue is growing, right? Mark Benioff is a great salesman, so he does a lot of sales talks, right? So I don't want to just look at what Mark has to say. I want that to be reflected in the business. The bigger concern, even before this whole agent force came in, the bigger concern that I always had with the Salesforce was there is no good bench strength in this company. Anyone, and you can go back and look at the history of Salesforce, anyone that has tried to be at a level in terms of, hey, maybe that person can replace Mark Benioff, they leave the company. In its early part, Salesforce had tried co-CEO model, didn't work out. People reach up to the level of CEO, then they leave. So I'm a little bit concerned on the bench strength. Growth in the Salesforce over the past few years, majority of them has been just coming through acquisitions. Organic growth is what I'm looking at. They acquired MailChimp, they acquired Tableau, they acquired this, they acquired that. It's been all through acquisition, acquired Slack. So I have a forget about in terms of, hey, is this AI going to disrupt and all that stuff? That's the reason why I have never been able to, convince myself to invest in a Salesforce because of these things. They have shown revenue growth, but is it organic or is it through acquisitions? So, now, coming back to what's happening right now, is it cheaper? I think Salesforce is one company which probably could get disrupted. In my corporate life, we had used Salesforce, but we used only a small portion of their overall suite of products, right? But we'll have to pay for the license for the whole suite of products. So the moment we found another company, a smaller company, giving us, insights into our renewals, etc. We had an account with them. They had built a connector to Salesforce. And sure, now with an LLM, etc., I will probably be, if I'm a company, I'll say, let me build myself. I don't even need the rest of the 95%, only need 5% of what Salesforce has to offer. Then why would I want to pay them the full fill fee? That's my concern. I have a much bigger concern around the corporate governance and why Mark has not been able to build some bench strength. So I would not invest in Salesforce, even though it might look cheaper right now. I don't know, but I have a hard time thinking what after Mark, or what kind of a environment is in Salesforce. Why do leadership doesn't stick there? Someone can correct me, but I think there are a lot of a churn at a top level had happened on Salesforce.
Anyways, Benioff seems to schmooze with Trump. So don't you think he has the ability to do an Ellison?
Yeah, maybe I don't invest based on your political connections or what you can do it, because who knows after November or after 2028 who is in the White House. All right, Sri, you have your hand up.
Yeah, I take it this top 15 is your core portfolio. And what percentage is the total 15 part of your portfolio?
Oh, we can add it up. I didn't add that up. So 66, whatever, let's say 22, then 32, 42.
So it's probably about 40% or so.
Maybe 40, 50%. Who knows? Yeah.
Sounds good.
So this is core, this is my whole portfolio, right? So trading, retirement, everything included. Because I don't want to look at, I'm not the one who will say, okay, this is my public account, this is private account, this is trading account, this is non-trading account, this is savings account, this is investing account. For me, I want to look at overall portfolio level and then take my decision. So this is all of my investable assets, including retirement as well as non-retirement.
And this is the one which is making the most money for you.
Sorry?
The top 15 are making the most money for you for the year.
No, I mean, I've not looked at that perspective. When it comes to the making money, mostly is coming from our options, right? So that I can look at an Optalyzer to see which tickers are working. And maybe in a 12 o'clock session, we can get through it and see which tickers are working, which tickers are not working. That's the deeper insight I get over there. Now, and those are the realized ones, right? If it is unrealized, maybe we can, the next phase I can build that in terms of look at even unrealized gains, which are the tickers making most money.
Making money can be broken down as an income. I think what he's asking is more income than the actual wealth. What you have is like showing the wealth part of it, I think.
Correct. So income you will see on Optalyzer, because those are all the closed trades I look at. So hold on your horse. Maybe in 12 o'clock, that's the area where I will look into. I classify it as an income only if I've closed the trade, right? Otherwise, it is still paper money.
Hey, hello. Hey, Vivek.
Yes.
Hey, this is Sammy. So for long-term investing, this ETF strategy, I like it actually. So basically I have two questions. So basically, should we have an automatic investment setup actually, especially, you just, since these are long-term, you just invest it on a monthly recurring basis. And also, if you have to recommend top 3 sectors, actually, you mentioned about SPY, which is about, 16% of your portfolio. But if you have to recommend in a long-term basis, a top 3 sectors or something, what would you advise?
So you invest only in sectors if you understand that sector, first of all. Okay.
Mm-hmm.
Or you say, hey, I want to stay, I understand real estate. I like real estate, or I like AI because I work in AI company. I like tech because I work in tech. I think I can understand it better in terms of the cycles, etc. Only then I would invest in a a particular sector. Second reason of taking sectoral exposure could be I want to also have a little diversified set of uncorrelated takers in my portfolio so that if one is, one zig, the other zags, right? Hey, so 2022, a lot of these the tech companies were down, and 21 energy companies were higher, right? So if you want to have the diversification, that's another reason why you may want to get a sectoral exposure. Now, a lot of my exposure is on the tech side because I understand that space better than others. Now, coming to, you asked me which one to recommend. I don't think I can recommend anything because I don't know what your makeup is, what kind of investor you are. I can tell you what I've done for my kid because she has absolutely no idea, no time to look at it. Right? So invest in SPY, some QQQ, some emerging market, little bit on a bond exposure. Which I think I gave her 5. I'm like, I set it up for her. I said, you have neither the interest nor the time to look at these. So in your retirement account, let it be on a on autopilot. Every 2 weeks, paycheck comes in, goes into the retirement account. And I remember when I started my journey in US, I had like 6 or 7 ETFs because I had no idea about how the market works here. Forget about forget about the individual companies, So I'm like, okay, I'll just start with the ETF while I educate myself. So there is no shame in maybe picking just the ETFs and sticking to it. Now, SEHD is a dividend paying ETF which has got companies which generate spare cash and hence they are able to pay dividend. I'm not a dividend investor, but I know the companies that have spare cash generally do well if there is a concern in the market, right? So that will provide me some ballast, some base to build on, some, the solid base on which I can build on some more, other risky or little more volatile companies or exposure, etc. So find out which sectors you're interested in and whose sectors you understand. Otherwise, stay broad-based. S&P's top 500, maybe SCSD will give you a lot more cash flow companies. If you want to go on the small and medium, IWM is there. More than the sector, first is asset allocation. Then comes within that asset allocation, how you want to do it a sector specific. That's what I would say. Focus on. Kunal, you have your hands up.
Yes, Vivek. Just continuing with what Sammy was mentioning, I think my current investment spread is like 80% in ETFs in Vanguard, right? And then maybe just Apple, Nvidia, and just something like that for individual, which is very starkly different from your split up, which is 16% and so on in ETF, and then a lot of the individual stocks. So is there a sound strategy, or is 80% too much reliance on a handful of ETFs? Should I diversify and do more research and get more of these individual stocks? What's the generalized take?
Okay, so here's my story. You're seeing the portfolio today.
Yeah.
Right, as of end of May. If we had seen the portfolio when I started my journey, we were 100% ETF. Right. I only started investing in individual stocks when I got interested, when I taught myself how can I read through some financial statements, earning statements, and start to make some sense out of it. Until then, I did not invest in individual companies. So there is, and you having 80% in ETF, you are doing better than 90% of the money managers. Right? Because they don't even meet the S&P index over 15-year period. You have done better than 90% of the Wall Street firms. if you're invested in S&P. And along with S&P, if you have a NVIDIA, you probably are sitting in the top 1% when it comes to the returns. So absolutely don't feel compelled to buy some individual stocks. You will not. Holding an ETF doesn't earn you a place in the party to brag about, I found the next 10 bagger, or you know what, hey, this stock has gone up 50%, I own in my portfolio. But you're not looking for those bragging rights. If you're looking to manage your money so that it is there for you when you need it, TCA in an ETF is great. Don't feel compelled. Unless if you're interested in knowing about the companies. Sometimes I get an exposure just to get a skin in the game so that I can then push myself to know more about the company and read about it. I take some what I call as a dipping a toe in water position. Right? Only then we should think about it. Great thing about individual investors, us, we are not bound by any mandate. You want 100% ETF, if you are a money manager, probably they won't allow you. The regulations will prohibit you by putting 80% in one ticker. I think ETF is still fine, but as a you not be able to buy 80% in, keep 80% in NVIDIA. As an individual investor, we have a lot of freedom. We can do whatever we want to. So don't feel compelled. Think that you need to buy individual stocks. I think was there a book or an article? Say 3 stock portfolio. Only 3 ETF is good enough. And someone can correct me. I forgot those 3 ETFs, or I think 1 bond, 1 international, and 1 US. And many people have retired on 3 stock portfolio. Maybe Google for it, 3 stock portfolio. That's good enough. I own it because I love reading about these businesses. But then I also understand that these will be a lot more volatile than what a normal S&P 500 could be.
And I think that's the key. What you're mentioning, the volatility is the key, right?
Yeah, it is.
It's your risk-taking appetite. Like either I'll be okay with this 2% and 7% increases, but I also have to accept they might go down 10 or 20%. Like,
sure.
Do I have that tolerance, or do I want to stay safe at my 20% returning ETFs and call it a day?
10% is nothing. Like Zscaler down 33% after earnings.
No, that's blood pressure causing.
Yeah. So don't feel compelled. Saying others are doing this, or you are responsible for your family. Should care the least about what your neighbor does or what I do. Okay. Don't say, okay, Vivek is doing that. I should never ever follow anyone who's on a YouTube or on the Saturday meetups. Okay, do your own thing. Understand yourself as an investor, what helps you sleep well in the night, and just stay with it. And maybe 2 more questions, and then we'll jump onto the ETF section. Nitesh.
Vivek, you mentioned about the Apple call option being pulled away. So how do you manage those type of
No, it hasn't been pulled away. Okay.
It was out of money then.
No, it is still it's in the money because I think I started on Apple. I sold a strangle on Apple, means I sold a put as well as a call. Now the stock start to go up. I think my call strike is at 300, and then start to roll up the put. Maybe I thought maybe I had a put at 260. I rolled it up to 275. Now rolled up to 295 or something. Keep collecting premium, right? And now my short call is at 300. I will probably manage and roll it out to July expiration, right? And don't want to let my stock get called away. So these are the things that I talked about. If you look at the video on the website or on the option bootcamp, in terms of how you manage a position that is challenging you. It's been great. I love that the Apple is challenging me, because I did only on a portion of the holdings that I hold. I sold a covered call only on that. My coffee can portfolio, this is something which I've implemented in Optalyzer, it'll tell me, hey, you're already sold more calls than, or you are allowed to, you should be selling only 1 call because you want to hold X number of shares in a portfolio. Right? So my rest of the Apple stock has done great. Maybe 1 contract is being challenged, which I'll try to manage it. Right? So there is no losing position here. Hey, only thing is, oh my gosh, I could have gained a little more. So what I've been over the years, there have been situations wherein, if I've not done these options, probably I would have been in a worse situation. Nilshan.
Hey, Vivek. So I saw you on your account. You have QQQ. Yeah, the QQQ ETF.
Yeah.
I'm just wondering. So I was reading up about it just this like couple of days ago, and I saw there's a few versions of it. There's QQQ and there's a QQQM, and I was wondering if there's a version for Canadians that you know of that we could invest in, and a little bit more about like how its performance and why you picked it.
So there's a SPYM also. So if you are, so I'll tell you the difference between I think QQQM and QQQ. I assuming the difference is same as SPYM because I did cover SPYM versus SPY in one of the sessions. The M version has got a lower fee in case of SPY. Someone please, you can check in QQQM what's the expense ratio. But on SPY, SPYM has got 0.03 as an expense ratio, right? Which is even lower than some of the Vanguard funds. But it does not have much of a liquidity. So if for me, liquidity is important because I also trade options on it. So for me, that's why I'm on a QQQ and not QQQM. And I'm on SPY and not SPYM. Okay. But if you're a buy and hold investor, right, SPYM from a performance perspective is similar to SPY. Okay. And I think the net benefit to you will be even more than SPYM because you're paying less in expense ratio.
Right.
But if you are like you want more liquidity in it, which I would want because I trade options on it, then SPY has got a lot more liquidity. So I think it's on a Fidelity website somewhere in that meeting I shared a link. They've explained beautifully in terms of depending on your investing / trading, how you trade, which instrument you should pick. So last year, I talked about one of the sessions, I think also posted on LinkedIn and maybe on Twitter, saying easy $1 million profit decision that I took, easiest $1 million that I made in my life last year was moving my kids, switching from SPY to SPYM in my kids' retirement portfolio. Right. And then, the kid I got 40 years or 50 years, whatever, of life. When I put in my software, between the expense ratio difference between SPY and SPYM, it turned out to be $1 million in next 40 years. I mean, that's the easiest decision, like 5 minutes. Sell this and buy this. It's in a retirement. It's in my kid's retirement account, so no tax consequences. So I sold all SPY, bought SPYM in my kid's account, which the expense ratio difference will amount to $1 million in next 40-45 years, whatever the time period was. But in my own account, because I need liquidity, I am on SPY. But if you are not, because you don't trade or options, or if you no need of liquidity, just buy and hold and don't care for next 10 years, SPYM is a great thing. Maybe QQM is similar.
Understood. Yeah. Vivek, so the reason I asked about that is I want to like buy and hold, right? Like on my retirement account.
Yeah.
And I already have the Vanguard, the S&P, but just wondering between the two QQQ version, maybe if I can find a Canadian version, I'll do that. What do you think? Like, is it more like obviously it's more, I guess, tech-based stocks in QQQM? But if I'm looking at a long-term horizon, like 20 years, is it a safe bet to go with QQQM on my retirement account, which I don't even touch the money for the next 20, 25 years?
So QQQM will have the same exposure as QQQ.
Right.
Right. So and the same volatility as QQQ. So if you are comfortable with QQQ, saying, hey, I'm going to take tech, sure. But also remember, like tech was down, NASDAQ was down 90%, 80% after the dot-com crash, while the market was down, overall S&P market was down maybe 30 or 35%.
Right.
Right. So if you're the performance comes with the cost of being volatility. And if you can ride through that volatility, sure.
Okay.
QQQ was down 40% in 2022. Overall, S&P was down 18%
Right.
in 2022. So it comes with the volatility. So that's the price you have to pay.
Good. Thank you.
All right. Let's jump onto the ETFs. Since we are talking about ETFs and mutual funds, this is a perfect segue. So thank you for setting up the segue. I did not know you'll have questions on ETFs, right? They're all random stuff. Ad hoc questions coming in. Okay, so let's talk about ETFs. Because I did prepare something around the ETFs. Oops. There we go. As a retail investor, here's our guide to ETF, right? There are a lot of ETFs that are coming, or the funds, right? Applies to both. And we'll talk about the difference between them and how you should make a decision. But investment funds / ETFs have become a primary vehicle for our investment. If you go into your 401k, you don't have access to individual stocks. You have access to funds, right? Even on the brokerage account, if you're not active, and like I've been saying it for years, no shame in owning ETFs, no shame in owning fund, right? And most of the Americans investors have majority of their investment in these, either funds or the ETFs. Right. We have more than 10,000 open-end mutual funds and ETFs available. We have more ETFs than the stocks. Like we have only what 4,000, 4,200, and this is the number from Morningstar. We have 4,200 stocks that are listed, but then we have like 4,400 to 4,500 ETFs that are traded on US exchanges. And ETFs, underneath, they hold the same 4,200 stocks, but there are more ETFs. So as a retail investor, we could get overwhelmed in terms of what should we do, how should I pick up, which one I should buy, which one I should not, right? So this is a little bit guide for you guys to come to a decision, or these are the things you should look at when you're trying to buy these funds or the ETFs. Gone are the days when the SEC allowed only the ETFs which met a certain bar or a criteria of in terms of what kind of investment they want to hold or what kind of fee they charge. They're not charging exorbitant fee, etc. SEC is not a merit regulator, unlike in some countries you may have. And I get pissed off when people say, how could SEC allow this? Dude, SEC is not a merit regulator. It's a disclosure regulator. If you can disclose in your S1 or in your prospectus that this is a poison, don't drink it, SEC will allow you. Go ahead, sell it. Now it's up to the investor to read and say, okay, this is a poison, right? Don't drink the poison and then say, oh, come on, how come SEC allowed? So we have many ETFs in the market. So we as an investor have to do our own due diligence and homework because no one else is going to do on our behalf. They probably have declared it in their prospectus. We need to read it. Gone are the days where an SEC will say, okay, I don't think you should be doing this. This is not good for investors. No, investors have to decide. This is a price of freedom. You have freedom to invest wherever. Then you're also responsible for making sure you're investing in the right things. First thing, the biggest one, what is, when you buy an ETF or a fund, one thing is certain. What's that? Come on. What's the certainty that you have when you're buying any of these instruments? Everything else is uncertain. One thing which is for sure is the fee. Exactly, it's the fee or expense ratio. Taxes, it depends on, you can hide, you may not have to pay taxes if you buy ETF and keep in your retirement account. Or taxes depend on if there are a lot of a churn or not churn. What holdings can change, management can change. Future performance is the least unpredictable stuff. Most of the retail investors, most of the DIY investors, we always look at the past performance and we try to project it towards the future and we invest based on that. my gosh, this ETF is up 30% in this last year. Right? Sure. Is that a guarantee that will be up 30% next year? No idea. But that ETF is charging you 95 basis points. Is there a guarantee that they continue to charge? Of course, unless they are forced by market participant. But of course, that is the only thing that is guaranteed in these instruments is the fee. That's a mathematical absolute. Everything else is dependent or can change in future. So control what you can. As an investor, I cannot control taxes. I don't know when the ETF is going to sell the stocks. Only thing I can control is the fee. First thing you look at is what's your expense ratio, right? In the similar category, right? I don't compare expense ratio or large cap growth fund with a niche Roundhill or or Calamos or other funds. Compare in an equal category what's the expense ratio is. Right? This is what let's say like I told you, right? Expense ratio for between SPY and SPYM over 40-50 year period turned out to be $1 million. It adds up. Power of compounding. You may not think 0.09% versus 0.03%. Who cares? Like 0.06% difference. It matters when you start to compound it over next 40-50 years. So 1 basis point versus 3 basis points, right? Huge. I think I have a chart here. You should always compare within the same asset class, not across it, right? If you're looking to buy a small cap fund, compare with the other small cap funds. Emerging market fund, compare with emerging market fund. Large cap fund, compare with the large cap fund. This is the drain that you see, between a 1% expense ratio and a 0.03% expense ratio. Tens of thousands of dollars over a long period. It's only looking at 30 year. Look at a 50 year. It's going to be $1 million difference. That's the money that we leave in the pockets of the ETF issuers. That should ideally belong to you, but we give it to them because we're not paying attention on what the expense fee are. Jack Bogle had done a great favor to all the retail investors is focusing on lowering the expense ratio, right? So there is no reason for us to stay invested in one fund versus another if I can find a cheaper one and pay less fee. Okay. Second thing, who is managing the fund? Right? You look at the ratings and say, oh, come on, this is a star fund manager. Sure, is that person still around? Is the person left? Right? Because you are paying up for the expertise, right? And this will apply only if you are paying an actively managed fund. If it is a passively managed index fund, then obviously there is no impact of the fund manager. You can put a monkey in a fund manager, excuse me, in a fund manager seat, and they'll just replicate the index. So there's nothing fee, and that's why the passive funds that track the index are much lower in expense ratio than the actively managed because they don't have to have a portfolio manager figuring out where to invest in. They just track an index. And by the way, the investment in the passive index has now exceeded more than 50% of the overall investments that are going into the stock market. Whether good or a bad, time will tell. But if you're investing in an actively managed fund, look at the performance of who the fund manager is and what has been the performance of the ETF while he has been the fund manager, he or she has been managing the fund. Right? Is the manager who built the track record still there? What happens if you are a star fund manager? You build a ETF, it performed well, it basically beat its benchmark. You get poached by another issuer, you go away. As a retail investor, I look at it, wow, this fund has performed so well. But what I don't know is the person who actually did all the hard work is no longer there, no longer managing that money. So then if it is dependent on the portfolio manager because the fund manager, because it is an actively managed fund, then it's basically the whole past performance is of no use. It's like you change the captain and the coach, or pick either one, and then you're still thinking, oh, I think the team has performed well and will continue to perform well. No, the key player has changed. So look at the manager who built a stellar track record. They are looking at it still there. Right? Number two, even if a manager is there, have you looked at a good enough period where the manager has gone through one full cycle of bull and bear? There have been many investors who and the fund managers and the ETFs who do great in the bull cycle, and then they lose all their value. ARKK comes to the top of my mind. They haven't, they're still down 50% from where they were in 2021. If you had seen how ARKK would have performed in a bull market and a bear market, I would definitely feel that you will rethink your decisions when you're investing in ARKK. I'm not saying it is not to invest. I'm like, just understand how it performs in a different market cycle. And then think, is it for you? You rode the wave of ARKK being up 80%. I don't know. I don't know what the real numbers were in 2021. Right? But they were like gazillion percent up. But then are you also okay with them being down 50, 60%? Over 10, 15-year period, probably they're done okay. But there's been a huge roller coaster ride. Right? Can you withstand that? And if you're not built to go through the ride, you probably will sell off your investment at the worst possible time. So manager is a star fund manager there. Is the current manager been able to go through the one full round of a cycle, which could be a market cycle, bull bear, which could be a economic cycle in terms of recession and expansion? Have they been able to go through that or not? Third is this issue dependent on manager or they have a committee which manages this? Because if it is a committee, then your risk of that you invested in based on an individual manager, now that manager is left. So that individual star manager risk is reduced. Right? So there are some funds who favor committee approach. But again, you may not find this that many funds are actually the decisions are taken by committee. Right? But if it is, you know that the risk on an individual fund manager is very less now. Third, when you're starting into a fund, and especially if you're investing in a small cap, right? And this is where it attracts a lot of investor. They invest in a small cap where they're gonna go bigger. And if you look at the performance of that fund, you will say, oh my gosh, that fund has gone up like more than the S&P 500. And at that point of time, if you want to invest, you need to understand one fact which is called small cap asset bloat. It doesn't apply to the large cap, but especially to the small cap, because small cap are also like higher performers in terms of give you better results, and they're also a lot more volatile. But then if the small cap, which was a $500 million fund, and it has now become a $5 billion fund, then the whole composition is going to change. Now it will not be able to buy the small cap companies which they were able to buy when they were $500 million fund without moving the markets. Right? So just because of the size of the fund, there could be some mandates, like some funds are, I'm only a small cap fund. If you're only a small cap fund, then don't invest the fund that has already grown too big. And the mandate is still that they're a small cap fund. It means by mandate, they have to invest only in small cap companies. then they will not be able to find a lot of the small cap companies in which they can deploy a lot of capital to make a meaningful dent or move the needle meaningfully for their fund portfolio. Look at a Berkshire Hathaway. It's not a fund, but kind of similar concept applies. Berkshire Hathaway is sitting on so much of a cash because for them to move the needle on their overall business, they need to find a company which is worth 20, 30, 40 billion dollar. They can't buy a company of $50 million or $100 million and invest in it. It's not going to move any needle for them. So the investment become more and more difficult. Like Berkshire Hathaway doesn't invest in small companies anyway. Even if they were, even right now, they have a problem in finding large companies at that stage. If you're looking at a small cap, then see in terms of how the history of that fund has been. Have they already moved from being a small cap to a much bigger fund? Then you may not be able to get that same level of edge that they used to have. Because now they have become the market itself. That they have been the biggest player in the market. Look under the hood. This is my most, I would say, a pet peeve, that we as an investor, we invest based on the description or the name of the fund. We don't look back and say, what is in it? What are they holding? They claim to be a space economy fund. Are they actually holding space-based companies? What are they holding in it? The marketing label and the holdings can vary. I don't know what the legality of that is, or how much the SEC enforces in terms of what revenue of those companies should be in this space before you can call it as the name of the fund as that space. I have no idea. But my personal experience, I've seen many ETFs or funds having name X, but the holdings is in some different sector. So if you go just by the name, you will do a disservice to your portfolio. You think you are getting iPhone, but inside the package, there may be a lower priced, low quality phone itself. So always check what is under the hood. Large and is it giving enough diversification that you're looking at? So one ETF, which again, sorry to beat up on ARKK, but they have some space fund, right? ARK space ETFs. John Deere, what has that to do with the space and defense? Amazon, most of the revenue, there's not much revenue from Amazon, neither the space nor on the defense side, right? Alphabet, it's a search company, advertising company. So when you're investing in these, you need to find out what actually are they investing in, right? Does this meet your objective why you wanted to invest? Because hey, I don't hold, like if you look at my portfolio, I don't hold any space companies. And I will be willing to go and buy this, but then I end up buying Amazon and the Googles, and I think there are like similar some ETFs, name is something else, and then you realize that Nvidia is the second biggest position. Come on, what is Nvidia doing in this? This is not even a chip or semiconductor ETF. The name was something else. Right? So always look under the hood in terms of what these companies have in their portfolio. I've been surprised many times. Check their concentration. Right? If the top 10 is like 70% of the fund, you have a concentration risk. Even though we think that investing in ETFs give you diversification, no longer the case. Now there are some ETFs who will have only 10 or 15 stocks. Now go figure out. You're a highly concentrated ETF. And you might think that in your portfolio, you are holding 7 or 8 ETFs. And you think, oh, guys, I'm well diversified. If you're not looking under the hood. But then you realize that there's 7 or 8 ETFs, all of them have a similar holdings. So your top 10 is hugely concentrated. That's not good for us. Now, as long as you understand, I'm not saying good or bad, let me take my words back. As long as you understand that, we shouldn't be blindsided by it. So that's why I think in a plug for Optalyzer, what additional functionality that I built was I own SPY, I own Google, I own QQQ. I don't know what my overall exposure to Google is. But I have a view in Optalyzer which will tell me, oh, you own 16% of SPY. That will translate to whatever 1% of Google. And then similarly, looking through all the ETFs that I hold, it'll then tell me what's my overall exposure to Google is. Because I struggle with the same problem. I own Google individually, I own NVIDIA individually, and then I own QQQ, which has got NVIDIA, then I own SPY, which has got NVIDIA, then I own SEHD, which probably has got NVIDIA. No, I don't think it has NVIDIA because NVIDIA is not a big dividend payer. But you get the gist. So you might think that you are diversified, but in actuality you may not be unless you look at the holdings and then figure out what's your net impact. Similarly, sector allocation, right? Some of the fund sectors saying, okay, we are benchmarking ourselves to like a high tech, right? Oh, we are benchmarking ourselves to S&P 500. And then S&P 500 has got 35% tech, but your fund has got 70% tech. Then that's not that you would want to buy because you thought since it's being benchmarked to S&P, it'll probably relatively match S&P. But now this is called a sectoral drift. Sometimes the funds holdings will drift away from the index that they were supposed to track. Or the style will drift away. Right? You became a small cap, now the small cap companies have become bigger and you are no longer a small cap fund. When you're looking at the performance comes very late. All these things you need to know first before even we look at the performance of the fund. But what most of us do? Okay, the first thing we do is how it has performed over the last 10 years. Without even thinking about, should I buy this? What does it hold? Is it going to give me make me more concentrated on some individual tickers, etc.? We don't even think about it. And all of us done the same mistake. Once you have qualified it through these other lenses, right? Then you look at a performance and see, hey, does it match the index? Does it have gone through? How did it perform in 2022? How did it perform when the market was in bear? How did it perform when the market was great? Can you withstand that volatility? I think this is more on you. If the fund has told is going to hold XYZ holdings, and those holdings tend to be a lot more volatile, fund is doing what it told you it will do. Question is, you need to know, can you go through the whole pendulum swing of really bad year to the really good year and can stay invested throughout this cycle? Right? When you're looking at a performance, just don't pick up. Fund manager will talk about their best years. Right? No one wants to talk about the year where they lost money. That's our job as an investor to go back and look at how did it do in 2022, right? Hey, last year did great. Let me go back and look at a previous economic cycle. How did it do in a recessionary cycle? Because things will change. Things will not always stay rosy. Right? Cycles will continue. Question is, will you be able to stick with it when the cycle turns around? Finally, is the tax efficiency. Right? If you're in a 401k, probably you can ignore it, or retirement account doesn't apply to you. But if you're holding in a taxable brokerage account, and this is where I love owning ETFs than the mutual funds, because ETFs are tax beneficial. I mean, not beneficial, but as compared to mutual funds, you can control when you will get taxed. In mutual funds, unfortunately, you cannot control when you'll get taxed. Even if you have not sold anything, those mutual fund units, you still have a tax bill. It is because the other people have taken the action. Right? And number two, what we as an investor should be focused on is what my net return after tax. What the fund managers will tell you or the prospectors will tell you is this side, right? Pre-tax return. But what if that fund manager is having a lot of a turnover? Means that they are buying and selling a lot of stocks. All the time they sell the stocks that have appreciated, they get hit by a tax bill that they have to pay, which in turn they'll pass it over to you. So your net tax return may be very different, or even for the fund. So when you're looking at the fund performance, try to find out what is a net tax or net return after tax. So I think in this scenario, ETFs provide you some shield. Unfortunately, if you're owning mutual funds, you don't have any shield. The only thing you need to look for is maybe go back Morningstar and see what their after tax returns are. Right? More the portfolio turnover, more will be the taxable gains. And God forbid if this pushes you up in the higher tax bracket, then you have to pay higher taxes on all the other income that you may have. Like you have a W-2 income coming in, and whatever other income you have. And if these higher tax because the portfolio manager is churning out the portfolio a lot, if that pushes it out higher in the taxable slab, you might have been better in not investing because now you're paying a lot more tax on the other stuff. Okay. So Morningstar has got something called tax cost ratio, right? So which will tell you if it is a fund is returning 8%, but is 1.5% tax cost ratio, you know you are eventually keeping 6.5%. So compare that. But if you are owning ETF, probably this will not be applicable, because then you will control your own taxable liability. Final stuff. All these things, if you own a mutual funds, go and do this homework. Not gonna take a lot of time. It's a 15-minute check that you should do. Check the expense ratio and compare it with the category average. You can find the category numbers on Morningstar. Right? Say, hey, I'm invested in the large cap semiconductor. You can find the category on Morningstar. What's the averages? Are you paying too much? If you are paying too much, okay, I need to review this. Then check how their fund has performed over 5-10 years, etc. How the fund manager has performed in different cycles. And if they've done well, if they've done good in a bullish cycle, or the economic expansion cycle has not done too bad in a recession one, yeah, keep it. X-ray the top 10 holdings. Are you buying the same 5 stocks? You got a semiconductor ETF, you got a QQQ, you got SPY. The top 5 holdings or top 10 holdings are all the same because all is AI. Right? Then you're not at all diversified. Right? And check the tax cost ratio and then make a decision. Whether you want to still hold this or not. Right? So that should be your quick, 15 minutes check. I'll skip the talking to your HR. I don't want you to get in trouble in talking to your HR and say, I want self-brokerage links so that I can buy individual stocks or ETFs. But it could save you tens and thousands of dollars, or maybe in some case $1 million, like in my case of my kid, over a long period of time. Takes you 15 minutes to do this homework. Yeah. Do it for yourself. No one else is going to do it for you. Right? And I shouldn't say this, but maybe if you have a financial advisor, they may have a different motivation why they are keeping you in some funds versus other. Go and question them. If you find that you're holding the funds which are expense ratios like way higher than what the rest of the market is, go and ask them. And if you can't get a satisfied answer, fire them. Find another another money manager or financial advisor. Or learn yourself to do it. Financial advisor charging you 1.5%, it's gonna be a huge difference if you can manage on your own. All right, maybe the fancy ETFs I'll cover next. We just hit 12 noon mark. So I'll stop right here. Unless you have some more questions, 5 minutes on another question, then I'll get into a breakout room to help out those who either have registered or try to do anything on Optalyzer, and there'll be a working session for onboarding for those
Could you
people.
be sharing this presentation for ETFs?
The recording will be up there. Yeah.
Okay, fine. Two questions, right? One is when you look at the fees, like you said, right, every category could have different fees. So you just compare within the categories, right? The fees.
Yes.
Right. Okay. And then even when the ETF doesn't, suppose the ETF went down and the market also goes down, like what happened in 2022. So I suppose you have to compare with what the market did, right? Because obviously the ETF would have gone down if the market went down in general.
No, but let's say if you're investing in an ETF, which is like absolute return ETF, right? It means they're long short.
Yeah.
Right. In that case, you need to know when you're investing in ETF, what are they claiming to be, and are they sticking to that or not? Right. That's my overall stuff. If you are claiming to be an absolute return ETF, it means when the market is bullish, probably I'll not perform. I'll probably underperform because I'm trying to hedge my position. Sure. But in 2022, if you lost a lot of money and all like market loss, then what the heck? I didn't get the upside in a bullish run and I got all the downside, then I don't want to be with you. So look at the objective, what the ETF claimed to be, and that was your thesis to invest in it. Now, are they staying true to that thesis or not? That's how I think we should evaluate.
Right. And what's the average?
Yeah, go ahead.
Like would I think I've got like ETF, FCNTX. I forget what their expense ratio is, but I think it's like 0.5, 0.6. Does that seem reasonable?
See, more the exotic ETFs, higher will be the expense ratio. Let's say if you're looking at a very niche ETF, because then you need a portfolio manager, or there are some leverage ETFs, etc. I've seen expense ratios way higher. Again, there is nothing right or wrong. It's always comparative, right? Let's say whatever the ETF that you hold in your portfolio, if there is a similar ETF in the market with a lower expense ratio, having a similar holdings, then I would switch. But if there is nothing and I want exposure to the sector or to the companies or to the theme that this ETF is investing in, then I have no other choice. Then I have to stick to that. Right? So that's how I think I would evaluate is if I'm convinced that I want exposure to that, or I want, whatever exposure to whatever that ETF is holding. And then I look for, is there anyone else in the market, from a decent issuer who's having a similar ETF and lower expense ratio. If not, then I have to pay through the nose, I'll pay through the nose. Then I'll question myself, why do I want exposure to this?
I rely a lot on Morningstar reports, right? I don't know how accurate they are.
I think from a numbers perspective, expense ratio, etc., that probably will be accurate.
Thanks.
And holdings, etc., you can check on an ETF prospectus itself. Like ETF has it. There are websites which will give you the top holdings of ETFs and all that. Cool. All right, I'll start the breakout room and I will go in the. If you want to join in the Optalyzer, but I will try to help out those who have signed up on the beta and held them on board to make use of the tool.
And for the others who have signed up, you slowly add them on, right?
Correct. So if you have Thinkorswim or Fidelity or which was the third one?
Schwab
or Thinkorswim is same, right? Schwab.
Yeah.
I should say Schwab, not Thinkorswim anymore. I use the tool, so that's on. If you're a Schwab, Fidelity, or Tasty Trade, you are probably first in the queue. But
because I did sign up for it, but I didn't get an email from you that I'm.
no. So yeah, no, I saw this because I only onboarded 10 people.
Okay, got it. Okay.
Right.
So you slowly
If
onboard the
you're a
rest.
think or swim, yeah, then I'll probably next week I'll add more folks on those who are on these three platforms. Yeah, so there are I think around 40 people signed up, and then I only onboarded 10. I'll
Got it.
slowly onboard it. And but for E-Trade and I think Interactive Broker or there was one or Robinhood, I haven't even built it because I don't have account in this. So I'll need some help from whoever wants to be the first one to share it. You can anonymize the data and then I can build that functionality. Okay, so breakout rooms are open. So we have, you know, rooms for swing trader, day trader, and all that stuff. If you want to stay around in the lobby, feel free, chat among yourself. I'll probably join the Optalyzer breakout room. If you want to join in there, that's fine too. You can get a peek at the tool or how the tool works, etc. So that you know later on, if you once you get an invite, then you know what to do. Alrighty. Oh, come on, I have to stop recording.